Welcome back to the Deep Dive. Today we are jumping straight into ReNew Energy Global, ticker RNW.
Yep, we're looking at their Q2 Fiscal 26 results from their call on November 10th.
And this one was complicated. It was a really fascinating report.
It really was. You had this weird split, right? On one hand, massive operational growth. They're moving forward on vertical integration, and the privatization deal is getting clearer.
But all of that good news was sort of overshadowed by this short-term noise that led to an EPS miss.
Exactly. So our mission today is to cut through that noise. We need to figure out what's temporary, like the weather impact, and what's permanent and strategic.
Like the manufacturing business and that take-private offer, for you, the listener, we want to give you the tools to decide if this is a growth story or if it's really just an event-driven stock right now.
Okay, so let's start with the snapshot, the numbers. It was a classic mixed bag, which totally explains why the stock was so volatile.
Right. Strong on the top line, but a miss on the bottom line.
The top line was great. Total revenue came in at, $434 million?
Which blew past what the street was expecting. They were looking for about $403 million. And that's 29% growth year over year. Very healthy.
But then you get to the EPS number, the GAAP EPS.
Yeah.
And that landed at 13 cents, but the consensus was 17, so a 4-cent miss. And even though management always tells you to look at EBITDA, the market, it reacts to that headline EPS number.
Of course. And that's what caused that initial choppy sort of negative price action right after the release.
Right. But if you look at the metrics they want you to look at, things are booming. Adjusted EBITDA for the quarter was $296 million. That's up about 8 or 9%.
And the first half of the year is even better. Adjusted EBITDA for H1 was $602 million. That's a 24% jump.
That's the real signal. That's the underlying momentum. And what was so interesting was seeing how the market sort of figured this out during the week.
It did, didn't it? The stock fell at first, but then it came all the way back up later in the week.
On huge volume, too. Almost double the normal activity. It suggests the bigger money looked at that EPS miss and just said, nope, that's temporary noise. We're focused on the operations.
Okay, so let's dig into those operations because the scale of what they're building is just massive.
It really is. Since October of 24, they've commissioned over 2.1 gigawatts of new capacity.
And that increased their portfolio by 22%. That's after selling off some assets, too.
And they are not slowing down. Just this fiscal year, they've already commissioned over 1.2 gigawatts, mostly solar, but some wind, too.
And they reiterated their guidance for the full year, right?
They did. Still guiding to build between 1.6 and 2.4 gigawatts. The pipeline is definitely executing.
Okay, but here's where it gets really strategic, I think. This whole move into manufacturing.
The vertical integration play. Yes. Their solar module and cell business is fully stabilized now. We're talking 6.4 gigawatts of modules and 2.5 of cells. This is not just a little side project anymore.
No, it's becoming a core financial piece of the business.
It's a huge piece. The manufacturing side contributed, 3.3 billion rupees in adjusted EBITDA just for Q2.
Which is roughly $40 million US dollars. I mean, that's a material, predictable source of earnings.
Very predictable. And because it's doing so well, they actually raised their guidance for it.
They did. Upwards to, 10 to 12 billion rupees for the full year?
Yes. And that's a critical signal for investors because, when you're just a power producer in IPP, your revenue is tied to the weather. It's volatile.
Right.
This adds a permanent layer of high margin, stable earnings. It completely de-risks the business model.
And they're not stopping there. They're already expanding it.
Already funded and expanding. They closed a $100 million investment from British International Investments.
That's for the new TOPCon cell facility, right? The more advanced tech.
Exactly. 4 gigawatts of it.
Yeah.
Construction is already underway, and it should be fully commissioned by the end of fiscal 27. It's a huge move to insulate themselves from global supply chain risk.
Okay, let's shift to the balance sheet because for a company growing this fast, leverage is always the big concern.
And this was a huge success story this quarter. Consolidated leverage. So net debt over their trailing EBITDA, they brought it down from 8.6x a year ago to about 7.0x now.
Wow, in 1 year. That is a massive reduction.
It gives them so much more financial flexibility. And if you look just at the operating assets, that leverage is at a really healthy 5.5x.
Which is below their own internal ceiling of 6x.
Right. It just shows a really mature approach to managing their capital, even while they're scaling up so quickly.
Okay, so if the execution is strong, manufacturing is booming, the balance sheet looks better. We have to go back to the original question. Why the EPS miss? What were the headwinds?
There were two major ones, and they're both kind of specific to the Indian market right now. The first one was just bad weather.
An extended monsoon season.
Yeah, a really extended one. And that just means less sun, which means lower performance from their solar assets, lower PLFs.
So the plants are running at a lower capacity, basically.
Exactly. And that alone created a drag on adjusted EBITDA of about 1.7 billion rupees in the quarter. It's purely temporary, just weather.
Okay. And the second issue was infrastructure, the grid itself.
Yes. Transmission bottlenecks, especially in a key state like Rajasthan. It led to what's called curtailment.
Curtailment is when the grid operator basically tells you to turn your plant off because they can't handle the power.
That's it, precisely. You have a perfectly good power plant, ready to sell electricity, but you can't get it to market.
So you just lose that revenue.
You lose it. And that had a huge impact in the first half of the year, about 10 billion rupees.
Which is, let's see, that's roughly 120 million US dollars.
Yeah, it's a big number when your quarterly revenue is 434 million. So management thinks this will get better as new transmission lines come online, but it was, without a doubt, the biggest reason for that EPS miss.
And I guess the skeptical question would be, isn't grid curtailment kind of a systemic risk in a fast-growing market? How can you be sure this isn't just the new normal every Q2?
That is the core tension here. And management's answer was basically to double down on their guidance.
Right.
They reiterated their full-year FY26 adjusted EBITDA guidance of 87 to 93 billion rupees. And then they specifically said they expect to land toward the high end of that range.
So they're basically saying we can absorb these hits and still deliver.
Exactly. Assuming normal weather from here on out, of course.
Right.
Their confidence is also helped by some macro tailwinds in India.
Like the S&P upgrade for India's sovereign rating.
Right, from BBB to BBB. That lowers the country risk. And then there was a policy change, a cut in the GST, the sales tax, on most renewable parts from 12% down to 5%.
Which just makes every new project more profitable.
Directly improves the economics, yeah.
Okay, so speaking of new projects, they've signed a lot of PPAs, but there was a note of caution in the call about the future pipeline.
There was. Management flagged that the environment for signing new power purchase agreements, or PPAs, is getting a bit slower, a bit more uncertain.
And this is specifically about the 6 gigawatts they have under what are called letters of award, or LOAs. They've been awarded the projects, but the final contracts aren't signed.
Exactly. And those agreements are controlled by the local state utilities, the DISCOMs. So that 6 gigawatts is kind of in limbo, exposed to any policy changes. Management admitted they have to be patient there.
Which explains why they're being careful with their capital, avoiding some of the more aggressive bids for things like battery storage.
Right. They'd rather maintain their returns and focus on locking down the more secure parts of their pipeline.
Okay, we have to talk about the elephant in the room, the privatization bid. This is what's really driving the stock day to day.
It absolutely is. And we got some real concrete progress this quarter. The board's special committee came out and officially confirmed they support the offer.
The non-binding offer from that consortium, Mastar, CPP, ADIA, and the CEO.
That's the one. So this is a big step. It moves it past just being a negotiation.
So what are the next steps? What's the timeline?
The consortium has been asked to turn that non-binding letter into a final binding offer. And the expectation is that they should get that sometime this month, in November.
And once that happens,
The indicative closing timeline is another 7 to 8 months after that.
that is a long time. So for the next 3 quarters, the stock is basically capped by whatever that bid price is, but it's still carrying all the day-to-day business risk.
That is exactly why the stock has been lagging the rest of this sector. Over the last year, R&W is up a lot, but over the last 1 and 3 months, it's actually down. The market is pricing in that weight.
That sets us up perfectly for our next segment. Now, this is not financial advice, but if we had to pitch an idea here, synthesizing all this, what's the trade?
I think you have to be long here. I think there's a really compelling long thesis. It's a classic arbitrage play, really. You're playing the gap between their proven operational strength and the sort of floor that this privatization event creates.
Okay, lay out the pitch. Where is the market getting it wrong?
The street is way too focused on the short-term noise. The monsoon, the curtailment. We've established those are likely temporary.
Okay.
The fundamental floor is incredibly solid. Management just committed to the high end of a very aggressive EBITDA target. The balance sheet is de-risked.
And you have that new anchor, that manufacturing business, which now has raised guidance.
Precisely. So the core catalyst is still that take-private bid. It's moving forward. The board supports it. A binding offer is coming any day now. And you have to believe that binding offer will come in at a meaningful premium to where the stock is trading today.
So the actionable idea is
Buy the stock. You buy R&W now. You use that stronger manufacturing guidance and the new TOPCon facility funding as your fundamental support. You're basically betting the fundamental floor is higher than the current price, and your ceiling is that take-private premium.
okay, but how do you protect against the risk? What about that 6 gigawatts of unsigned LOAs? That's a real policy risk.
Yeah, you have to hedge that. So to protect against that regulatory risk, you could layer in a small, long-dated protective put option below the current price.
So it's cheap insurance.
It's cheap insurance against a worst-case scenario, like if a huge chunk of that pipeline gets canceled. It lets you capture most of the upside from the deal while protecting your downside. It's infrastructure value meets event arbitrage.
So to wrap up this deep dive, Q2 was really defined by this strong operational story. I mean, huge revenue growth. That manufacturing business is firing on all cylinders. They're deleveraging.
And you have confirmed board support for the privatization.
Yeah.
But all of that good stuff was kind of masked by the short-term EPS miss from weather and grid problems.
The key takeaway seems to be that ReNew is successfully turning into this vertically integrated powerhouse in a really supportive market. But the stock itself, the equity story, is totally dominated by this take-private deal and its timeline.
Right. And that leaves a really interesting question for you, the investor. The biggest catalyst from here is just time. So do you wait for the final binding price to be announced and maybe miss out on some of the pop? Or do you bet on the fundamental strength right now, knowing management is guiding to the high end of their targets, and just accept that the privatization clock is ticking?